Well, hello, everyone. Thanks for joining this virtual SCAMP discussion about like the debt and equity panel. I'd like to take a minute to thank SCAMP for convening our in-person event yesterday, which seemed like it was a big success. And also I want to acknowledge the Herculean effort it must have taken to switch venues on short notice. So hats off to SCAMP for accomplishing all that. Before we start, I do want to ask everybody to hang on to questions until the end and to please put them in the Q&A down at the bottom of your Zoom screen or Zoom box. And then we will, then I'll ask each of our presenters to introduce themselves briefly, and then we'll get started with some questions. So I think I'll just do this alphabetically by first name. So I'll just ask David to introduce himself, please.
David Dolgite. I'm Director of Acquisitions for Merit Community Capital. We are California's only nonprofit, California-based syndicator for tax credits, exclusively focused on the Golden State.
Okay, Ari.
Hi, good afternoon. I'm Eri Kamiyama with Chase, and I'm based in LA, but I'm part of the West Community Development team. So we do lending all over California.
And Hal.
Hi, my name is Hal Lee. I'm a director at City Community Capital. We're the Affordable Housing Lending and Investment Group of Citigroup, and we're a national platform. We focus on construction and perm loan financing, as well as the agencies, Freddie and Fannie Mae, and I'm based here in Los Angeles.
And Sebastian.
Hi, I'm Sebastian Glowacki with US Bank Impact Finance. I'm based in Denver, but covered the California market on the equity side.
Thank you. And I'm Yasmin Tong from CTY Housing, Affordable Housing Consultant and Developer here based in Los Angeles, but working statewide. All right, so let's talk about everybody's, the hot topic, equity pricing for federal and state credits. What financial trends should our developers be paying attention to, and how will that affect pricing in the foreseeable future?
I'd say over this past year, in spite of the challenges we had earlier in the year, with kind of the regional banking issues in California, that pricing held sort of what we saw at the end of 2022. It's been kind of steady. Folks were able to support the deals they signed, and so for this, like looking back at this past year, I think we kind of stayed fairly flat. Looking forward, it's always hard to like pull out a crystal ball, and if I had a perfect one, I could retire tomorrow, and I wouldn't be on any more of these panels. But since I don't have one, I'd say best case scenario is things are kind of flat again going forward in 2024. It's the two things I think to keep an eye out for are, one, and everybody's just digesting this because it just came out, which is the final rule reforms on CRA and how that's going to impact appetite on the equity side, both globally in terms of the entire tax credit market, but also California specifically, given how the credit for one CRA assessment area is changing in terms of the ability to kind of spread your peanut butter across your whole assessment area rather than at a county level basis, which means we might see some urban areas in California pricing soften, but it might benefit more rural parts of the state. And then the second is just if it seems we're stable now in terms of the banking disruptions we saw earlier in the year, but the kind of full impact of the rate increases on the economy is still being felt. And if things start to soften next year, I expect appetite to go down a little bit.
I will. I completely agree with, concur with David on everything he said. I will add one other sort of caution flag, and that's rise in interest rates or cost of funds for for us on the bank side. Which we underwrite to a number of metrics. We speak IRR to the outside world, but we pay attention to 4 to 5 different metrics, and we have to underwrite to the lowest of whatever that metric, whatever the lowest metric is. Right now, it's the metric that is impacted by cost of funds. So IRRs have been creeping up, whereas our profitability is staying the same, if and going down depending on, again, which metric you're using. So I will I'll go out on a limb a little bit and say most deals right now we're somewhere low 90s. Some deals are 88, some are 92. We're right, it's somewhere right in that spot. I like to to think we can typically get to 90, 91, maybe 92 cents, which translates to approximately 6% 6 to 6.25% IRR.
Thanks. And then just overall investor demand. David, you mentioned the regional bank consolidation. So I would like for you all to kind of reflect on how that and any other things that are affecting pricing are affecting overall demand for credits.
Well, the other, I alluded to the CRA reforms, which were just published, and everyone's still trying to figure out how that might impact their CRA plans kind of going forward for their next cycle. And I was just talking to some folks earlier today, some syndicator peers, and one of the things that folks are kind of speculating is that projects in Indiana might benefit and projects in California might suffer because under the current regime, we're assessed the obligation, the CRA obligations kind of assessed at like a county or MSA level, and there's going to be an ability now to spread that out over one's entire kind of depository territory. And so, there are other markets in the country that are a bit weaker than California and get better yields. And so you might see more demand for product there since you can get as much CRA credit there than maybe as you would get in a deal in California now. And so, we could see a need to increase yields a little bit in California in order to keep the appetite for credits in California up to where they are now. I'd say on the plus, there still seems to be solid demand for state credits, and the state's been really supportive on keeping that $500 million in the budget each year, particularly for certificated credits. So I think in terms of any silver linings or bright stars on the horizon, there still seems to be good appetite for state credits.
And speaking of state credits, I don't think either one of you answered my question about pricing for state credits.
I think on allocated, it's we're probably still seeing things in the mid 70s to low 80s to mid 80s, and certificated a little bit more than that, depending on the deal.
Yeah, we're unallocated. We're at 79 cents, and really don't have the ability to go over that number. On the certificated, it does depend a little bit on the flow of credits, meaning if they're 1 year, 2 year, 3 or 4, there's a pricing differential. But we're in the low to mid 90s.
Didn't realize I was muted. Sebastian, was there anything you wanted to add to the conversation about investor demand just overall?
So far, and it's been a very busy fourth quarter as we were signing up the first deals for the first deals for next year. Demand definitely seems to be there, meaning we're seeing a lot of competition for now. I don't know if I'm expecting it to really dry up over the next 6 months or so. But I definitely think that there is some flight to quality, and flight to safety for sure. So maybe that's a little bit of why I'm seeing a lot of a lot of competition for certain deals because of the sponsorship, their structure, subsidies, different types of subsidies, things of that sort. So I think that's going to also be a driver for where we see additional interest is in the in the safety, quote unquote safety of the deal.
Thank you. All right, lenders, let's talk about interest rates. We're not anticipating major rate increases anytime soon, but aside from like budgeting additional interest rate cushion, are there strategies you can suggest to, or products that you can suggest to manage interest rate risk for borrowers?
Well,
go first,
maybe I
Ray?
go first, but yeah, I mean, yes, you mentioned that it's been calming down, but still it's been going up, right? So still we have challenges closing deals, and I think everybody managed to, I mean, the last year was brutal. 2022, early 23. I don't know how we all managed to, close deals, but we all did. So kudos to us all. And you kind of mentioned that aside from building in cushion, but I cannot emphasize enough how important the cushion is, right? So within like 3-4 months, rates could go up substantially, and just most recently the perm rate's been going up quite quickly. So always emphasize to build cushion. It's never it's always important. But aside from that, yes, a lot of our clients purchased caps and swaps in the past year, and I'm sure that they help substantially. And we've seen rates keep going up, and we don't know what comes in 2024. And they definitely comes with risks, so we should, always emphasize that. But we all kind of need to look at different, ways to hedge those risks. So
Yeah, I would just echo what Ari said. I mean, just having the expectation, because one of the things that when we see a borrower's pro forma, one of the big differences is always the interest reserve. The borrower always generally thinks that it'll be smaller, and ours is generally going to be a little bigger. So just having that expectation and building that expectation, in addition to adding the cushion. At Citibank, and I think at a lot of banks, we've been adjusting our interest rate cushion for sizing the construction loan interest reserve based on where rates are. At one point, we were at 125 basis points, then we were at 100 basis points. We're at about 75 basis points right now, but we are trying to react to the reality of rates. And I know other banks are doing the same. And similar at Citibank, we have seen just building in the cushion yourself, but also we have seen clients also do rate caps, collars, swaps, but you just want to make sure that that those have complexities, and you want to make sure your developer understands those risks. But it's just one way of just hedging some of that interest rate risk during construction. Yeah, and rates are going up. I mean, today rates dropped dramatically as well. So you just never know. So people ask, where do you see rates? I mean, we just don't know. So but I would just say again, just build in the expectation and cushion into your own underwriting. That'd be my 2 cents.
Thanks. Would either one of you want to talk any more about, you mentioned swaps, collars, interest rate caps. I guess the question I have for you is whether you think those are appropriate for all borrowers. What kinds of borrowers do you think are best suited for using those kinds of products?
I would say that those are complicated financial instruments. So you want to make sure you fully understand it. You have to hire a financial advisor. So I would say, make sure you understand what you're getting yourself into before you sign up for something like that. That's what I would say.
Yeah, and especially on swaps, there are upsides, but there's also downsides. So you kind of need to be prepared for that. And we always, need to have kind of pretty accurate or pretty good kind of, schedule of, disbursements or draws, because those will be priced based on that schedule. So if you are not right about them, you could be losing money later. So yeah, it's pretty complicated. I totally agree with Hal.
Yeah, that notional schedule, like, so if you think before you execute a swap or rate cap, like, you have a schedule and say in month 2, in your schedule you think you're going to draw $500,000, but you actually drew $700,000. You're only covered for the $500,000 that's included in your schedule, right? So you have to account for that possibility that it's not just a possibility. You're not going to draw according to your schedule. There's going to be some variation, right? Nothing's going to be on schedule, and so you have to account for that and know that risk.
Great, thank you. All right, so for the whole panel, it seems like underwriting, because of all the volatility and interest rates and insurance costs and just different things that are occurring in our sector, what are some of the common pitfalls you're seeing as you underwrite, and how can developers avoid those and just how can developers avoid those or try to plan ahead in terms of structuring their projects or preparing themselves to answer questions that you maybe didn't ask previously?
Unpack, I'd say making sure you're staying on top of kind of what your likely premiums are going to be on insurance, both on the builder's risk and operating. And I know it's hard to get a quote out of a broker on the operating side for something that's not going to be placed for 2 years, and so they may be giving you a quote with a lot of padding in it. But just making sure you're on top of that. I've sometimes seen deals where, like, the last time someone's talked to their broker was like a year ago, or they're using some formula that their broker gave them in the distant past that doesn't really apply anymore, and then having a big surprise when they actually go out to the market to place their coverage. And that's both the coverage, both on the builder's risk side, where we're seeing 6-figure blowouts on that number, and then on the operating side, where similarly scaled blowouts result in a massive reduction in a significant reduction in the perm loan. So that's something I think that folks really need to stay on top of, where in the past you maybe didn't need to be as frequently on top of it as some other things. I think someone was in the chat might ask about rate cushions. This is just me. I think kind of like the historic practice on rate cushions on the construction debt at this point's probably safe, where people are putting 100, 125 basis points in on the cushion, just because I have a hard time seeing the Fed, raising rates another 100 25 basis points over the next 2 years, including their own forward-looking projections, are actually showing, not much more in the world of rate increases unless inflation starts exploding again, which does not seem likely. So I think kind of using what you'd normally use for that is probably fine. The perm rate piece is the one where I think we're still in going to be in a space of volatility for a while. Because right now we're still long-term rates are still below short-term rates on the bond markets, and at some point that has to change. And it will either change because short-term rates go down or long-term rates go up, or both of those two things happen. Which means, where the 10-year bond is right now, how intimated, well, it fell today, which in my mind makes things worse because the inverted curve just re-inverted itself, and we were in a trend line where it was starting to uninvert. So at some point, we could see perm rates going up even higher than they are now, even if short-term rates fall a bit. Because at some point, there needs to be a return. There'll be a return to kind of the historical spread between short and long-term rates, which is probably, another, meaning long-term rates could go up another 100 basis points at this point. So you want to really build a good buffer in on your perm rate projections for your deals that you're looking at now, just to be on the safe side would be my recommendation. Maybe how's the perm loan guy? So he might have some different thoughts.
No, I don't disagree. I think you have to, build in some cushion in your underwriting and set your expectations right and not overextend, because you don't know where rates are going to be. So, I mean, other issues that, just to go off of that topic, just on other issues, I mean, I mean, I am seeing a lot more just complicated deals, lots of, I mean, this has been the trend, but even more so now, many layers of sub debt, and just a lot of, and it just makes the deals more complicated, different subordination agreements, different restrictions on those sources that are senior to the lender. So like when we do a new deal, I always ask the borrower, hey, can you tell me, to the extent what sort of restrictions are there and which one are senior? And like, if there's a density bonus agreement, is there a land use covenant, like those type of things, like we try to find out as early as possible, so that one, we can know about it and underwrite to those potential risks. And then two, we want to make sure it's in our appraisal. Sometimes we find out about, these restrictions like last minute, and they just go into the appraisal, and it becomes a last minute scramble. So just as deals get more complicated, there's more layers, more restrictions, more parties to work with. It becomes increasingly important for, if at least from my perspective, but I would think everyone agrees that, just to be upfront and be transparent and over communicate those layers and the complexity that those different sources come with. Just my 2 cents.
Yeah, and I'd add to that, and this is kind of an emerging kind of underwriting trend for us, and I'm starting to hear it more and more from investors and lenders, is the permanent supportive housing and underwriting it. Just based on what's been happening with some sponsors, what happened with Skid Row has gotten people nervous, and there are other examples nationwide of similar organizations having portfolio failures. And so kind of a lot more scrutiny, I think, is going to start being applied to vacancy rates assumed on the PSH units, adequate operating budgets that have enough cushion in them to absorb higher operating costs for services and staffing, and maintenance. Those sort of issues kind of come to mind. Like, I think PSH is in for a bit more scrutiny maybe than it has received on an underwriting side in the past.
I totally agree. Yeah. On the perm side, because we used to, those PSH deals didn't used to have perm loans, but now all the PSH deals need perm loans, and we are in for 17, 18 years. So there are a lot more scrutiny, especially on the expenses. And now we are kind of asked to answer all these questions when we issue the term sheet. So be prepared that you'll be asked a lot of questions when you issue the RFP for terms. It's almost like we need to understand the expenses, we need to understand the security plan, we need to understand the population, how you lease units, and who the service providers are, and what that service budget is. All these things will be asking. So.
I will add to that, operating reserves as well. We've gone to 3 months for a really long time. That's been the standard. I think with the higher number of PSH units, I think 6 months is going to be more of the standard on those projects. And then to backtrack a little bit, the other, I think we need to get very real about construction timelines and conversion timelines, because we do it one way, and the credit deliveries, we do it one way up front to maximize the price, but then and then we have to beg forgiveness on the back end, because can we pay in the money a little bit early? These things aren't ready, but we're almost there. And I get it. We're trying to accommodate every request in that sense, because these were, when we were signing these deals up, we didn't know that the world was going to move on us a year and a half later. But now we sort of know where we are. We need to get more real about it. And, we are getting surprised, as David said, with, especially insurance prices. And they're not necessarily $100,000 off. It's $500,000 off on a deal that had $2.2 million of developer fee. Half of it was deferred. And now we just, another $500,000, went out the door, plus extra carry costs, things of that sort. We're starting to scrape the bottom of the barrel. So I think we need to get more real about timelines.
Yeah, and I would say that we are seeing a lot of construction loans needing to be extended, like as of right extensions. So like before the pandemic, I saw a lot of more just like a single 6-month extension. But in recent years, especially with the pandemic, we've been adding multiple extensions, 2 extensions, and even then sometimes it's not enough. So I'm seeing almost every other deal I dare say needs there's a delay, whether it's construction or it's a subordinate source. It's all these reasons that we're seeing lots of delays. So we're trying to mitigate that by building in more extensions into the documents.
Yeah, and I'm curious, investors, about, it used to be that investors really, it was sort of rare to fund at construction completion. Like there was always a huge chunk of equity that would fund a conversion. Just wanted you to comment on that, in terms of trying to manage that interest rate cost that comes along with all these extensions that you're talking about.
We're looking at that more and more. We have done that on some deals where that was not set up when we closed, and we've gone and amended our LPA to allow for it. And then also now looking at it kind of on the front end at deal signing. On the ones that we had already closed and we're adding in, it was to help the deal because of they deals that got caught with the rapid short-term rate increases during construction, and all of a sudden their interest carrying cost was more than our yield. So we're more than happy to have it to analyze, what's the impact on our yield versus what's the savings the deal might have by bringing our money in earlier, and if the math makes sense for the project, we're willing to accommodate that. It impacts our pricing a little bit. But that's what I mean by doing the math for the client, that we look at, okay, well, it'll be a little lower pricing on our end, you get less equity, but you're likely to save this dollar amount, and if your savings exceed my price reduction, then it makes sense. Or in some cases, folks, it's kind of a net zero, but the surety of being able to just say, okay, I'm done, here's the money, even if stabilization takes longer or conversion takes longer because of some soft lenders who take longer to convert, particularly the state, just to have that kind of insurance policy, as it were, by the ability to call our money early. We've been working with more and more sponsors on that.
Yeah, same here, for the exact same reasons. And I will, we've even gone to, typically we've done 5% equity pay in up front. We've been moving more to 10%, even 15%. And then having some portion come in at C of O. And the only caution I will throw out there is we're not worried about lease up risk. That's really never been a worry. It's about the underwriting guidelines, principles, essentially, and to make sure that the takeout is still it's still safe, it still works at the end of the day before we put in 30% at completion. So upfront underwriting is sort of key for completion pay-in.
Okay. Another issue that we're facing in Los Angeles with permanent supportive housing is the cap on project-based vouchers in the city of Los Angeles. Yet there are a lot of tenants out there who have vouchers, but they're portable. I'm curious about how investors and lenders are looking at potentially underwriting tenant-based subsidy as opposed to project-based subsidy.
We like project-based subsidies. I think it's I think we have to really, I don't think I couldn't give you a firm answer on this, to be very transparent. I mean, but to look at it on a case-by-case basis and look at how does the GPR look like without the tenant-based vouchers, and how does it look like with the tenant-based vouchers, and what that variance is, and what is the upside and the downside. I don't have a clear answer for you on whether we are okay with it. I think it's a case by case. Yeah.
Well, that's good to know, right? But yeah, it's very difficult because it's not so much on the concern on the initial lease up. Probably it will be leased up, right? But we're in for long term, and what's going to happen in 10 years? That's the big question. And with the contract or the project based, we at least good for that almost term of the loan. So that's a major concern on PSH. The resources are running out, and we're concerned on the services also, right? Is it going to be there's limited resources and we're good for this year, but how about 5 years later, 10 years later, would there be funding sources available for services? So yeah, it's a tough question for all of us.
Are you going to say something, David?
No, just similar. I mean, it would be really hard for us, I think, to underwrite to mobile income. Maybe if it was a existing property that had a long track record of a certain percentage of units with vouchers, and then maybe we can underwrite some small percentage, and it was with a sponsor we had a long-standing relationship with. It would be, I wouldn't plan around it. It's just very challenging. And honestly, it's the sort of things, I know there were some folks doing this model, right, of trying to get around needing public funds and building cheaper by avoiding kind of public subsidies, and the only thing they've got, but they're leveraging off of kind of mobile tenant vouchers through a kind of referral system for PSH tenants and all that, particularly in LA. And I think that will it's going to be more challenging these days given where rates are at and the general temper of not wanting to do anything excessively risky these days, just with everything going on. It just feels to me like a function of the zero interest rate policy world, where money was free, and so the risk was lower, and risk is back in the system now. And so anything that's kind of outside the box gets harder to execute on.
Um, I'm wondering if you've encountered projects that were anticipating, that had structured a capitalized operating subsidy reserve, and how you look at that.
We stress test them, I mean, I have a 15-year horizon roughly, right? And the coasters generally are sized on a longer period than that, so that gives a little bit extra runway. And we stress test for how high the expenses could get before we bust out of a coaster, paying the coaster out of our 15-year period. So it's not usually something the sponsors are seeing. We're doing that behind the scenes during our underwriting, but we are stress testing those coasters against like how far the budgets can go before the coaster runs out, and definitely got more scrutiny on that these days, just because some of the assumptions that were made around expense inflation on the operating expenses seem to be. I think the concern these days is they may have been too aggressive in terms of that they undersold expense inflation for the PSH units.
Yeah, and what if we have an increase of some sort somewhere that we recently got on insurance, let's say, in the 15-year cycle. So yeah.
And yeah, I mean, we're used to coasters, touched, by HCDs. It's getting kind of, more common, but we're starting to see more creative ones, like by local jurisdictions or funded by equity. Those, we need to kind of look more carefully in what the assumptions are and what happens, after that coaster runs out. And as a lender, we also need to look at refi scenario. So, upon maturity, is this loan refinanceable? And we need to have the answer of what's going to happen, in year 15 and how it's going to be restructured. So that's more questions definitely on non-traditional coasters.
How were you going to say something, or?
No, I was just going to add to what Ari said. I mean, it also depends, who's providing the COSAR, like if it's a government entity, and what is, is it subject to annual appropriation risk? How does that work? I mean, those are the kind of things. But if it's it's those kind of things matter, and how long is it committed for? Is it 15 years, or is it yeah, and all the things about the exit, and how do you pay off your loan at the end of your loan term? What happens if the COSAR isn't there? Does it work? Those kind of risks. So we do take a look at that.
Yeah, I think we're going to be seeing more and more COSARs as if things progress as they happen. So get ready, everybody.
I mean, from my perspective, Yasmin, like in some ways, I mean, this is the inverse of probably how some lenders would look at it, is like a coaster that's being funded out of my money over time is more secure than if it's a HCD coaster. I know it sounds weird, but like I control my own funds. If I'm bringing and they're less restricted usually, right? Like so the from HCD, it's formulaic. There's annual limitations on how much can be drawn off the coaster, right? And there's a whereas if it's a sponsor funded one, that's likely coming from equity. There's more flexibility to utilize it typically if costs go over a certain amount. Whereas with the HCD ones, you can go up to 7%, I think, of the total coaster amount in any given year. And so in some ways for me, it's a little more complex. It's being capitalized up front. The money we can stick it in a long-term interest-bearing account, make a little more money on it, so it can fatten up the coaster over time. So for me, there's some advantages to the sponsor coaster because of that stronger amount of control we have over it than when public agencies kind of funding it and it's not even capitalized, it's just a kind of annual like grant coming into the deal. So.
Thank you. All right, let's see. The next question has to do with preserving unsubsidized affordable housing, and that's becoming a growing priority as a homelessness prevention strategy. Are there? I'm just curious if your organizations are working on anything to support these kinds of projects that don't have subsidy, don't have operating subsidy, might be able to get capital subsidy, but are just unsubsidized affordable housing. Okay, guess not. So
Well, I would
are you going to say
say
something?
it's very tricky, and I know there have been very successful examples by some of the developers, and that's great. And in certain markets, I would say, yeah, I've been in the CDFI world before this, and that's I know some CDFIs have funds to finance acquisition of these properties. And I've seen many challenges as well, as these properties tend to have many, deferred maintenance issues, overcrowding, etc. So it's not easy just go in and acquire and preserve, but when you go in, you need to fix a lot of stuff and then maybe relocate people, and that's a big commitment. And also, usually for LIHTC deals, developers go in and get the developer fee upfront. But on these deals, you are in and cash flow is pretty tight. So it's very difficult to make it work financially. So only certain developers who are committed to the market and the model can make it happen. But it's definitely not an easy task.
Yeah, and we don't do NOAA type equity investing here at Merit, but just from talking to some of my peers, there was some of that activity that a lot of it, some of it came from the healthcare space, and to the degree that some of those deals closed in California, most of the folks who had that capital have spent it, and there's another round now of folks of money for those kind of NOAA deals for the next kind of set of acquisitions they're looking at, but this kind of their latest capital is coming at a much higher cost, and so it's making the kind of NOAA transactions even harder to find deals that work in California, just because of the kind of cost structure we have here compared to NOAA type deals in other parts of the country, where operating costs aren't as high, and the acquisition prices aren't as high.
Yeah, I've seen NOAA's I mean, we've financed some of them, but via like through the agencies, like a Freddie Mac. But most of those have been social impact sort of developers or investors. And they have typically not been, at least in my experience, in California. They've been in other markets like Texas, Georgia, Florida, sometimes in the Chicago, Illinois area. So not high cost areas like California. And I've seen developers, buy properties, put in social enrichment services, those type of things, but and keeping the rents affordable without a regulatory agreement. I've seen that, and we've done that with the agencies. So it's basically a market rate property, but I haven't seen that here in California.
Right. Then I think then the next question, oh yeah, so this has to do with GP consents to transfer limited partners interest. So David and Sebastian, could you talk about that? Because I think we are seeing now some of those older tax credit projects through syndigators, or that are going away, or you know, we're seeing that the those ROFR that they're really trying to take advantage of the developer
Mhm.
and to get paid large sums of money in order to exit. So just kind of curious about how your organizations are dealing with that.
That's a good question. I mean, you know, for us, we're a nonprofit syndicator, and you know, over our 30-plus-year history, we've never sold off a portfolio or an LP interest to unrelated third party, and we've always honored our ROFRs. But that said, we're always open to structuring the deal because we know it's a concern. You know, so typically, with the nonprofits, you know, we're giving them 90% of the back end, which that helps reduce kind of a theoretical value for the LP's back end interest because now you're only getting like 10% of a projected fair market value. You know, we're willing to look at structuring it so that the reserves kind of go with the whole thing and aren't negotiated separately because that's often a piece that folks have run into difficulties with. Some of the more aggressive LPs is, you know, having to fight over who gets the reserves. On the consents, you know, we've gotten generally comfortable with language in our LPAs that kind of that limit our ability to transfer our interest without GP consent if the transferee would be some sort of bad faith actor with a demonstrated history of challenging rights of first refusal and the like.
So very similarly, we're a little bit of a hybrid direct investor and a syndicator. You know, although you know that us being a syndicator is a relatively new thing that started in 2010, 2011. And you know, and in those situations, we only do guaranteed funds, meaning we're still in the deal through you know, for 15, 16 years. So we have an ongoing interest, same as what David just said. We do offer the 90-10 you know, splits, things of that sort. So you know, this is not new space for us going forward. You know, similarly, we do, you know, we're open to sort of eliminating certain you know, certain known organizations.
Forgot to unmute myself. So the state of California is channeling a lot of resources into set-asides for emerging developers. So would like to give you all the opportunity to tell us about how your organizations are also responding to support emerging developers. And, you know, is it financial assistance? Is it, you know, underwriting, what expectations on guarantees? I think there are lots of different forms that the support for emerging developers can take place. So I want to hear all about it.
Yeah, we've actually had a dedicated team and a dedicated very large pot of money for emerging developers, and so it's a little bit of everything. You know, the pricing is a little bit different. The benchmarks for, you know, yield benchmarks are lower. Underwriting is you know, not necessarily project underwriting. Sponsor underwriting is very different, and it's designed to essentially maximize the amount of the developer fee that will be kept by the developer, not having to bring in an additional co-sponsor. So, but like I said, we have a dedicated team, you know, that looks at deals across the country on this basis.
David, do you have anything you want to say about?
Sorry, was trying to unmute myself. Yeah, I mean we've historically often worked with smaller, and I should say, like, 95% of the projects we invest in are nonprofit sponsored, and historically we've often worked with smaller um, nonprofits in California, folks who can benefit from the soft kind of technical assistance we can provide, where they might have limited capacity. And when we're looking at those kinds of deals, we tend to try to structure around the balance sheet softness and the experience softness with what can we structure inside the deal itself to help mitigate some of the risks, particularly with if there's a public agency participating in the project, so that the deal itself can stand on its own a lot more separately from the financial or experience capacity of the sponsor, who may not have a really long track record.
Okay. How and Erie, is there anything you'd like to add?
Yeah, usually the challenge of these emerging developers are, kind of the operating working capital or pre-development money, and the bank itself cannot do, these type of unsecured financing. But Chase has funded multiple CDFIs. I believe 60 million last year or this year, and to fund these IBOC focus facilities, to provide working capital or pre-development money, unsecured money, so that they can start paying all these pre-development costs, and get these projects proceed, and to get all these public subsidies, right? It costs money, so.
Yeah, we've been active. I mean, we've been working with minority deposit institutions to work with them on, for example, construction loans, and participating part of our construction loans to them, and working with them and building that experience. So we've been active in that realm, and also just being active in the industry and working with folks, and working with all parties, just staying active in the industry.
Okay. All right. Well, I think we finished all of our official questions. Now we'll open it up to the audience to ask their questions. I think there's, so I think we're going to transfer the moderation then to Scanf, and they'll take over the Q&A.
Yeah, so first question is, what is your current appetite for PSH developments?
Has not changed. I don't know where we're landing this year. Last year, I'd say about half the units that we closed on were PSH. That doesn't mean half the projects were PSH, but just that half of the units in our portfolio for last year's fund were PSH. I think this year will be a little lower than that. I'd say our appetite has not changed, but our kind of underwriting is evolving. Stuff everybody was alluding to before, which is just having to do more stress testing on coasters, if there is one, and on operating expenses over time, on it's all stuff we were always reviewing, but now there's just more focus on it, even than the past. Adequate services budgets, who's paying for them, where is it coming from, who's providing the services, what's their track record, what's the adequacy of other line items in the operating budget, that kind of based on recent experiences around security and maintenance and repair and staffing loads. So appetite hasn't changed, but the kind of more granular underwriting has increased.
Yeah,
I mean,
sorry, Hal, go
for
ahead.
it. Okay, I was just going to say, I wouldn't say it's changed. I think obviously, as many of us have alluded to, like the analysis on the sponsor, and if you own a lot of PSA projects, we definitely take a look at your REO schedule just to see how your other projects are doing, and we'll scrutinize that more, and probably ask you more questions like, why is this property under 1.0 debt cover? And so those kind of questions have popped up more as things have developed in the industry. But I wouldn't say it's the appetite has changed, but the scrutiny on certain things has evolved a little bit.
Yeah, I'm going to mirror what has already been said. We don't disqualify a project simply because it's PSH. And it is, it's all about the underwriting, sponsorship, things like that. The one thing I will add, and this is very standard in any time there's, additional risk or perceived risk in the industry, is preview your projects to your potential lender and investors early, so no one's surprised by it. We know what's coming. Having a knowledge of what's coming in the next 6 months from from all of our partners is very important, because that way we can sort of tailor what the next 6 to 12 months is going to look like, prepare our credit partners for this is what's coming, this is why it's okay. Understanding the nuance of every deal is extremely important right now.
Yep, I agree with what everybody said. Definitely, we're still interested. We're looking at it. It's just more questions, and we really want to make sure that the sponsor understands how it operates, and if those projects are operating well. Because in the past we said, oh, okay, PSH, it would work with services, great. But now we actually ask, is it really working? And and how you make it work. So there'll be questions asked, but definitely I'm still in.
All right. Next question. Are you seeing a dramatic uptick in borrowers evaluating rate buy downs as a means to boost loan sizing?
This would be on perm loans, I would assume. Oh, I have not, but
You mean like on a where you pay more to buy down your I mean I personally have not seen that. Yeah.
Okay. And what is the best strategy to not have to use a rate reset?
What depends on what do you mean by rate reset?
All that's on the question, but maybe this person can type more about that. Another one is, are investors considering impact funds in lieu of tax credits? Is there viability to performing affordable housing utilizing this strategy in any way as part of the capital stack in lieu of LIHTC?
I was going to say, it's, we're not, I'm not, obviously I'm an equity investor. So I'm looking for, for tax credits, and we're really, set up more as a tax credit shop, not, not alternative, means of investments. Generally speaking.
same here. And when I've seen the models, they often require like a higher, it's still affordable, but a slightly higher AMI to really kind of make the math work. Because you're trying to replace what 30-40% in the capital stack of your source of funds. And if you pull the tax credit piece out, you might even be looking to need to pull out some of your public subsidies to kind of start making the math work, because then you're in a world where now you have to also like figure out how you can dramatically reduce your cost per unit to start making the math work, which means pulling out a lot of the public monies, which comes with strings attached, in order to like get your efficiencies down to make kind of this alternative private equity from impact funds work, because they do the yields we get from the tax credits are a tax subsidy from the federal government and tax losses. Whereas, on an impact fund, even though the yields are lower than like traditional equity, you still have to deliver some form of yield typically, which means, positive NOI and an investment per unit that's lower in terms of total costs in order to make the cash on cash returns work.
All right. And next question is, what would it take for lenders, investors to get comfortable with a backstop that would cover vacancy loss for projects using TVVs?
This is your voucher question, Yasmin, that we all dodged around.
Yeah, it's a modified voucher question.
Yeah.
So maybe the answer is we're not there yet.
I think this is a bigger question though for the industry, for the public lenders. How can we make this work? Then that'll be a bigger conversation, not with lenders and investors.
Someone asked, Sebastian mentioned moving toward projects that are safe and quality. What do you mean by that?
So one, sponsorship. So, as was mentioned earlier, the REO schedule is something we need to scrutinize and really look at, portfolio wide to see, what impacts, things as, in rising interest rates, rising operating expenses, reliance on subsidized, highly subsidized housing, that things of that sort. So it's primarily around sponsorship, and then also just operating expenses of the project to make sure that there's a little bit of wiggle room. They're not cut to the bone.
Okay. Someone says from year 1 to 15, the perm rate could be lower and then it jumps up at year 16 if the lender is asking for a rate reset to a higher rate. Could the deal keep the same rate through year 20 or 30?
So I assume that's about the perm loan. I mean, most of the loans that at least that I work on the perm side are, we call it 18 years from construction loan closing, or call it roughly 15 years. We try to keep it, kind of within that time period for a multitude of reasons, including the fact that we securitize our perm loan, or we make sure that it is securitizable. So we want to keep it sort of relatively standard. So I haven't seen too many projects where you have like a rate reset in year 15. Most of it's just, call it a 15-year term from conversion, sometimes a little more, but I haven't seen too much of that, at least for me.
And how there might be people in the audience who don't know what you mean by the loan to be securitized. So maybe you could just.
Yeah, so like banks such as Citibank, we underwrite. We want to be able to sell the loan, securitize it in the secondary market on the perm loan side. So that helps give us the ability to make more loans rather than necessarily always keeping it on our books. We underwrite most of our perm loans so that it is securitizable if we choose to securitize it. So that it needs to be relatively standardized. So.
Thanks.
And you guys touched on PSH a bit, but someone wanted to know, are PSH projects underwritten more conservatively than other affordable housing?
I mean, it's underwritten differently, and you can say that probably it's more conservative depending on, but it's for a reason, right? I mean, like vacancy on PSH, it takes longer to get those tenants. It's for example, through a coordinated entry system to get tenants, and so it just takes longer. And we have seen the history. PSH units take longer to lease up, so we have to look at it based on those facts. The expenses are higher, but that's because you have more expenses, higher operating costs. Sometimes you need bigger replacement reserve. It's just our experience working with PSH is just different than non-PSH. So it's just a different set of rules. So if it is more conservative, I think it's because of good reason, because of our experience with it.
All right, and someone asked about how do investors see that we can utilize the solar credits through the Inflation Reduction Act?
At least on our end, we have appetite for solar credits. We'll buy them as part of a LIHTC transaction. I've seen more deals kind of pick at adding them into their deal as a result of the Inflation Reduction Act, but not a ton that have actually gone through the headache yet. I think partially because as folks sort of got into the weeds on what was required to qualify for some of the boosts. They're either harder to fit the requirements, particularly around the domestic production on the materials and equipment. And then some of the other boosts are they're kind of capitated, and you got to apply for them through the Treasury, and that application window just opened. And then a lot of our clients are nonprofits, and this gets to your without getting too technical, but your earlier question around the back end stuff around the year 15 and how to protect the nonprofits' ability to get their project back. We're often getting requests for 90% of the deal on the back end to go to the nonprofit, which takes off the table a lot of the cost basis that can be used to generate the solar credits in the first place. And so the kind of, even with the extra boost, the kind of bang for the bucks, be kind of limited for the nonprofits if they're taking most of the back end. I know some folks are trying to figure out creative strategies around that, but to date, I haven't seen a ton, at least from the nonprofits, for when we actually get to the closing table, they've added in a substantial amount of solar credits for the arrays.
Someone had a follow-up, David. They wanted to know, will the boost in solar credits have an impact on the availability of LIHTC credit support?
I have not seen it on my end, and largely because the amount of LIHTC volume I'm getting asked to buy is up here, and the solar volume my hand is below the screen. So it's such a small percentage of the overall credit stack in our funds that it doesn't really impact the overall appetite.
All right, well, those are all the questions that we have. So any last words, Yasmin?
I just want to thank our panelists for their time and attention to this, and thank our audience for attending. Thank you, and SCAMP for hosting us.
Thank you, everyone. We will send out the recording to everyone who registered, and we really appreciate your time. And stay tuned for the next session that starts at 3:30.
Thank you.
Thank you.